Welcome to another episode of the best dividend stocks in Canada by sector. Today we're going to be jumping into information technology. There are not a lot of great companies who pay dividends in tech, and there are two reasons for it. First, they reinvest all their revenue and earnings back to themselves so they can grow their business because innovation is the key here. And second is that it showcases how small the Canadian tech space is. Let's get started. Hello everyone, my name is Alex, welcome to my channel. I hope you're doing well, I hope you're ready to write some code today. Because we're gonna be coding, yeah. We're gonna be looking at the best dividend stocks in Canada in information technology sector. And to get things interesting here, let's take a look at one of the best ETFs in IT, which is XIT.TO. So this one has around 19 holdings in there, and moreover, top 5 of their holdings control the 80% of the entire portfolio. This is crazy. So it showcases again how small the Canadian tech is, because this ETF is not focusing on dividends, it's just the ETF that contains the best tech companies in Canada. But there are still great companies in tech in Canada, which sometimes pay good or decent dividend, so we're going to be looking at those. So the US has its FANG, Facebook, Amazon, Apple, Netflix, Google. What do we have in Canada? We have Docs, Discarded System, OpenText, Constellation Software, Kinaxis, and Shopify. A well-balanced, diversified portfolio has to have an exposure into IT sector. This is 100% true, and this is what we want to do as well. So you got to invest into Docs. Docs. Docs or Docs? Docs. And even though there's not a lot of companies who pay dividends, you still gotta invest into IT sector. That thing is booming and innovation is everything nowadays. So let's take a look what we have here. Out of the 5 companies in the Docs, this is so funny, we have only 2 of them that pay dividends. And one thing I want to point out here is that regardless of what your portfolio structure is, what your investment strategy is, what stocks you're buying, whatnot, you gotta diversify your portfolio and invest into different sectors, different types of stocks, dividends and growth, both of them, right? And make sure you invest into ETFs, so you diversify your portfolio into a group of stocks, right? So that you're covered on all the fronts. And I went through the best growth ETFs on TSX in one of my recent videos, so go check it out. And also covered the tech sector for ETFs there too. Let's take a look what we have here today. The first one is OpenText Corporation. The ticker symbol is OTEX.TO. OpenText is an information management company that provides software and services to maximize the strategic benefits of data and content for increased productivity, growth, and competitive advantage. With a focus on information management technologies and services, the company provides customers with the capabilities needed to build resilient businesses. This company has fundamentals to be a great long-term investment. The $16 billion company has a great future outlook in the cybersecurity data management industry. It partners with big players like Google to provide software support. This company has been through the worst times, and it not only survived those times, but it also kept growing and provided a lot of returns for its investors. Let's see what we have here from our metrics. So the market cap for the company is around $16 billion. The current dividend yield is at 1.64%. Yeah, no, it's not the best deal, but it also deals with great share price appreciation. And also OpenText is a part of Dividend Aristocrat list, and they've been increasing their dividends for the last 8 years. The payout ratio is at 219%, so the company is still slowly coming back from the last year crisis. The 10-year share price growth is at around 475%, and the combined annual growth right now is around 17%. This is great returns for a company like this. One downside here is the share price is pretty volatile, so you want to be here for a long term. So OpenText is a pretty good long-term investment, which can provide you a very good sustainable share price appreciation and also some dividends on top of that. And if the company gets to the point where it's going to be very sustainable, they might start increasing their dividends in the future as well. Alright, let's move to the next one, which is Constellation Software. The ticker symbol is CSU.TO. Constellation Software is a leader in the vertical specific software services, VSS. So this vertical specific software services provides mission critical software solutions that target one or two specific verticals. Constellation adopts a private equity model where it acquires the small vertical specific software providers and bring them under its umbrella. Since the inception of this company in 1995, Constellation acquired around 260 different companies that operate in around 140 different verticals. Every new acquisition brings more cash flow from maintenance and professional services. The shares grew by 10,000% since the company started trading on TSX in 2006. So if you invested $10,000 in Constellation in 2006, today you would have $1 million. Where I was in 2006. Oh, I just finished high school. Good times. But who wants to look at back? Let's see what we have in the future for them. The good news is it's not still too late to invest in the Constellation and benefit from this growth. The company's growth by acquisition strategy played an instrumental role in delivering such results. Without a doubt, if they're going to continue doing that, then you can expect a lot of returns from this company. There's one downside, the dividend is pretty low. So let's see our metrics. The market cap is around $39 billion. The current dividend yield is around 0.26%. Yeah, it's pretty low, you're pretty much getting nothing from them, but the share price gives you a lot of returns back. And also 0.26 dividend yield can be a very good investment for your health, as you're going to be allowed to deduct taxes on your interest payments because you're going to be practically generating income from this stock. I actually talked about it in one of my recent videos, so go check it out. There's one more downside to this stock. The share price is at $1,879. So it's a pretty tough one to get into this, but there's a pretty good ETF XIT.to that has 25% invested into the Constellation. So that might be a good alternative for you. The payout ratio is 19%. Well, they're not paying a lot of dividends, so the payout ratio is pretty low as well. It also means that the company invested a lot into themselves in order to grow their business. And now the key point here, the 10-year share price appreciation is around 2,600%, which is insane. What number is it? How can you get returns like that? This is crazy. And if you consider how safe this investment is, I think it's one of the best companies to invest in the long term if you want to get some growth from it. The beta parameter is at 0.74, so pretty good here in terms of share price volatility. Alright, let's move to the next one, which is Inch House Systems Limited. The ticker symbol is ENGH.TO. This tech stock provides enterprise-level software solutions to its customers across the globe. Remote work, visual computing, and telecommunications are three areas that Inch House Systems specializes in. Inch House Systems also has an aggressive acquisition strategy that focuses on buying smaller tech companies all across the globe. Typically, the acquired companies range in value from $5 to $65 million. One of the key parts of Inch House growth strategy is M&A, which is short for mergers and acquisitions. That led him to drive pretty high returns of 18% annually in the last 5 years. Moreover, the company has a pretty clean balance sheet. They don't have any debts, they have strong cash position, and also a great investment portfolio of $260 million, which is up from $150 million a year ago. The company also cares about their investors. They had excess of cash last year and they paid an extra dividend of $1.50 per share on top of their annualized payout of $0.54, which is pretty good. Now let's take a look at our metrics for Inch House. The market cap is around $3.2 billion, so it's a pretty decent sized company. The share price right now is at $59. The current dividend yield is at 1.08%, so it's pretty low, but first we're getting a lot of returns back from share price appreciation, and Inch House actually is the part of the dividend aristocrat list. They've been increasing their dividends for the last 13 years, which is the longest streak in the tech sector. And to go along with the 13-year dividend increases, for the last 5 years, they've been growing their dividends by 17% annually. Crazy. But also sometimes the company pays out additional dividend. The payout ratio is at 27%, so it's pretty decent, and they also have a lot of cash sitting around that they reinvest back into their business. The current share price is at $59, and a lot of analysts say the share price right now is super undervalued by 25 to 30%, so we can expect their share price to go up in the nearest future. Which means right now is one of the best times to invest in this company, if this is something you're looking for. The 10-year share price appreciation is around 1,072%, which is pretty great number. The beta parameter is at 0.86, so the share price is not very volatile, so you'd expect the share price appreciation over the long term. And that's it for our dividend stocks in information technology sector. If you want to check out some other sectors, there's a link above on my playlist where you can go through them. Definitely check it out. And for now, thank you very much for watching me here. like this video, subscribe to my channel, hit the bell. Let's reach out to as many people as possible, and I'll see you around in my next video. Cheers, thank you, bye.